Australia's unemployment rate has increased slightly in June, rising from 4% up to 4.1%. According to the ABS, about 50,000 jobs were created during the month, which beat market expectations. The participation rate increased to 66.9%, which is close to record highs. Hours worked lifted by 15 million hours, and the underemployment rate fell to 6.5%. Well, let's bring in here Diana Mousina, Deputy Chief Economist at AMP. Diana, thanks for your time. 50,000 jobs created during the month, but the unemployment rate still went up. What's going on here?
Look, it was a pretty confusing jobs report, even for an economist to understand, and it sort of follows this trend in the past few months where we're getting a lot of conflicting signals in the labour force data. And the way that I best describe what's going on in the labour force is that the labour market is still quite tight. And the best way to read through a lot of those pluses and minuses with the participation rate and jobs growth is just to look at the unemployment rate, because the unemployment rate is really the key guide to what's going on when you take all of those things into account. And what we've seen is a slow trend up in the unemployment rate. It bottomed at 3.5% in late 2022, and it's now 4.1%. But even at 4.1%, it's still pretty low for Australia.
Yeah, just explain the significance to us of the participation rate being close to record highs. Is that really the key to why unemployment lifted in June?
So the participation rate is basically how many people are in the labour force as a share of the working age population in Australia, which is those aged over 15. So to be in the labour force, you either have to be employed or unemployed, which means you are technically looking for work. So the fact that we have a very high participation rate means that there are more people than usual who are either employed or looking for work. So that is generally pretty good news around the labour market. Obviously, people are feeling confident that they can find a job if they're looking for work. And that's really why the participation rate is at such a high level. And don't forget that we also have very high levels of immigration coming into the workforce every month. A lot of the permanent and long-term immigration is coming in through people who have already achieved or gotten some of those visas for work. So it does reflect those high levels of immigration as well. I think it's best to look at the leading indicators of the jobs market, though, because we know that the unemployment rate is actually a lagging indicator of the economy. So I look at the leading indicators of the labour force, things like job vacancies and job advertisements, and they're all still pointing down to lower jobs growth and a higher unemployment rate. And they've been pointing down now for more than a year.
Yeah, the Reserve Bank wants to see the labour market loosening up. How do you think it's going to respond to the numbers we've seen today?
Well, basically, the labour market is running in line with the Reserve Bank's current projections. Over the past year, the labour market has definitely held up stronger than where the RBA thought it would be. And we've seen the Reserve Bank revise down its forecast for the peak unemployment rate. They think it will get to 4.3%. It's currently at 4.1%. But over the past few months, it's broadly tracked in line with the Reserve Bank's expectations. With today's data just on its own, I don't think that there's any reason for the Reserve Bank to change its view on the current setting of interest rates or its outlook for the economy, because things are broadly tracking in line with their own forecasts. What could potentially change their view is the June quarter inflation data, which comes out on the 31st of July in 2 weeks' time. The inflation figures have been surprising in Australia for the past 3 months, especially that underlying or trimmed mean data for Australia. And if we do see a higher read for the trim mean, then there is a risk that the Reserve Bank will decide to hike rates again, because they've been sounding like they're still quite uncomfortable with the inflation outlook in Australia.
Yeah, a few weeks ago, the monthly inflation indicator came out higher than expected, and money markets, I think, maybe overreacted a bit, expecting the RBA to raise rates. Was there much money market reaction to today's numbers?
There was actually. Yesterday, the money markets had less than a 10% chance of a rate hike priced in by August, but those rate hike expectations have come down because of what's happened globally. We've seen a lot of central banks move towards talking about interest rate cuts, especially the Fed, and the Australian market responds quite a lot to that. But after today's data, we saw that money markets are now pricing in about a 25% chance of a rate hike in August. I think the risk is probably even a little bit higher than that, because we could see a higher trimmed mean number in the June data. It's not our base case at AMP, but it's definitely a risk that we have to be mindful of.
And then looking ahead more broadly, are you expecting the Reserve Bank to start cutting next year?
Well, we had been of the view that we would see some rate cuts in very late 2024, but we have pushed that back now into early next year. Our overall philosophy or our thesis on the economy is still unchanged. We think that the consumer will ultimately be under more pressure in the second half of this year from a rising unemployment rate, drawdown of those accumulated savings, and that continued weakness in household incomes from some of those drags of high interest rates and that fiscal drag, despite the fact that we've had some marginal tax cuts. So that hasn't really changed.
Diana, I'm sorry, we've run out of time.
What has changed is the inflation data.
Thanks very much, Diana.
No worries, thanks, Ed.